Hi, everyone. Thank you for joining today's Healthcare Industry Tax Update webinar, and happy St. Patrick's Day. My name is Rachel Gisser, Senior Marketing Coordinator of Withum's Healthcare Services Group. Before we begin, I have a few notes. Today's materials can be found in the toolbar on the right of your screen. Also, at the bottom of the toolbar, you will see a chat box. Feel free to send us your questions during the presentation. We will do our best to address them at the end. There will be 4 polling questions throughout the program. To qualify for CPE credit, you must participate in each poll. CPE certificates will be emailed to you within a few weeks. And finally, once the webinar is over, there will be a pop-up asking you to complete a survey of today's webinar. Please take a moment to complete it. It is our way of being able to provide you with the best and most relevant programs possible. We would like to thank our collaborators for this event who have collaborated with us in the past and continue to be our strategic partners, including the chapters within the HFMA Region 3, Hudson Valley HFMA, and HAP Evolve. Today's program will be presented by Scott Mariani, Practice Leader, Hayley Shulman, Senior Manager, and John Smith, Supervisor of Withum's Healthcare Services team. Here is a quick look at our agenda for the day. And I will now turn it over to Hayley Shulman.
Thanks, Rach. On the next slide, we're going to talk a little bit about the tax-exempt government entities update. Recently, they've released a fiscal year 2020 accomplishments letter, which is where this section is really going to focus, to just talk about their priorities and where their goals have been focused and what they've been able to accomplish over the last year. In the second part of this slide, you'll see a live link, which is a link to the program letter, the fiscal 21 program letter. Typically, this has been a 15-page document which outlines what the priorities are in detail. With the fluidity of everything that's going on, the IRS decided that this year this was going to be a quick summary. Not a lot of information provided, but we wanted to be able to give you guys that live link in case you wanted to take a look at it. One of their biggest accomplishments over the past year was mandatory electronic filing of Forms 1023 and 990, and this was really done in order to reduce errors and make processes more efficient for taxpayers. The division continues to invest in its workforce. The TEGE division conducted a huge hiring initiative, added 188 new hires, of which included 149 revenue agents, 4 tax compliance officers, 5 tax examiners, and 30 other staff. At the end of fiscal 20, there was roughly 1,600 employees within this division, which is a 3.5% gain from the prior year. And on the next slide, you'll see how those employees are kind of broken up. You'll see that 1,100 of the 1,600 employees actually belong and work within the employee plans and exempt org division, so roughly 70%. Which is where, you know, a lot of you guys are on this call today, exempt orgs, hospital organizations, and that's where their big hiring and employees are landing right now. On the next slide, we'll take you through, these are just areas that get identified. Rach, next slide. Oh, there we are. Oops, sorry, go ahead, one back. The TEGE compliance areas. These basically, during FY20, the unit continued to identify compliance issues through its strategy process. They utilize a compliance platform, which includes 6 programs, as outlined below, that these programs together promote tax law compliance by tax exempt and government entities. And these are these compliance strategies, data-driven approaches, referrals, claims, and other casework, compliance contacts, determinations, and voluntary compliance initiatives. On the next slide, we highlight some really great information on the examinations, which is something that I think us as tax preparers and you as hospital and for-profit organizations all kind of fear a little bit. Examinations and what the EO division noted in its accomplishments letter is that it had completed 3,240 examinations during fiscal 20, and these included examinations of the Forms 990 and their associated employment and excise tax returns. Overall, 88% of the closed examinations ended up resulting in a tax change, and 39% of the examinations were picked up from related examinations. So for instance, a lot of times we see an examination taking place for payroll on an organization, which ends up leading to more IDRs being issued in other areas, other compliance areas. Additionally, they also proposed revocations, which were both agreed and unagreed without protest for 36 tax-exempt entities as a result of these examinations, and of which you can see in the graph at the bottom, a majority of these were related to organizations not operating for an exempt purpose. On the next slide, you'll see that the EO initiated and continued several compliance strategies in order to address non-compliance. Hospital organizations with related business income, where expenses materially exceed revenue, thereby generating NOL year after year. Rach, next slide. It might be a little slow. Additionally, organizations that operated as for-profits prior to converting to 501c3 status was an area that they were focusing on. And as always, private benefit and inurement, which focused on organizations that showed indicators of having potential private benefit or inurement to individuals or private entities by way of loans to disqualified persons. On this slide, you'll see that additional compliance strategies that the EO division announced will include compliance with respect to Code Section 4960, excise tax on excess remuneration, employment tax issues, which deals with worker classification, taxability of fringe benefits, issuing a W-2 and a 1099 to the same individual, as well as employee benefit plans, including participant loans, and of course, IRS enforcement with 501R. And what you'll see here, if you refer back to the agenda, is this is where we really focus our presentation today, because we know that these are areas that the IRS is going to be looking at, intends to look at, and honestly scrutinize. So when we are, working with our clients, we're trying to make sure that all of the I's are dotted and T's are crossed. When you're doing due diligence, these are things that you really want to focus on as well. And on the next slide, just for informational purposes, we've talked about 501R. We will continue to talk about 501R because it is something that the IRS will continue to focus on. Our latest data is for fiscal year 2018, and in that year, the IRS completed 475 501R exams and closed 308 compliance checks. In addition, the IRS reported that it assessed over $150,000 fines to tax-exempt hospital organizations for various community health needs assessment violations. And on the next slide, just to bring it to conclusion, determination, something that we saw getting better when organizations were applying for tax-exempt status. Determinations were being made more timely. I think that's been severely impacted by the pandemic and folks working from home within the governmental, the EO division. But during fiscal 20, the EO closed 95,000 determination applications, which resulted in 85,000 approvals, of which 79,000 were approvals for 501c3 status. And with that, I'm going to turn it over to Scott to chat about our next section.
Great. Great. Thanks, Hayley, and good afternoon, everybody. I think Hayley did a really nice job of laying the groundwork for three major themes here. One, tax audits, tax examinations are on the rise at the federal level, the state level, and the local level as well. And we're going to go into some of those specifics this afternoon. Number two, you have to think of not only tax-exempt organizations in the healthcare space, but also for-profit organizations as well with respect to tax audit examinations. And number three, both for-profits and not-for-profits in the healthcare organization space, when you're doing mergers, acquisitions, affiliations, it's really important to get tax people involved and do tax due diligence. And we're going to cover some of these areas here this afternoon. So Code Section 4960, what we've done is we've learned a lot of good lessons the last couple of years since 4960 went into play, and that was with the 2018 calendar year. It's a 21% excise tax on basically remuneration greater than $1 million. And here are some takeaways. If you're a small healthcare system, one hospital and a few affiliates, it's pretty straightforward. You may have the CEO, COO, potentially, not a lot of people over $1 million for which you have to examine them in their relationship, and really just do the calculation and you remit the 21% excise tax to the IRS. But what it really does is it starts to get really complicated in multi-entity healthcare systems. And we're going to talk about a couple of examples in a few minutes as well. A couple other big picture takeaways here with the law and the proposed regulations that are out. Once you're deemed to be a, quote, covered employee, you're always a covered employee in future years. So in year one, you could have a maximum of 5 people who are deemed to be covered employees who are over the $1 million threshold, and the employer pays the tax, the 21% tax on the excess. And this is applicable to 501c3 tax-exempt organizations. Number 3 is an important takeaway. It's not who issues the W-2 to the workers for purposes of who's a covered employee, but you have to look at the common law employer-employee relationship, not who is issuing the W-2 to the individuals. Number 4, you need to think about the employment agreement as well, with who is the individual working for, her job duties, her day-to-day responsibilities, what organization in a multi-healthcare system is that individual actually working for? What does the employment agreement say? It may not be the same as the common law employer-employee relationship. And we've already done, and we know, and everybody has heard about the medical services exception. So if you have clinical physicians who are providing medical services, they're over the $1 million, and it's only medical services exclusively, it's exempt from the 21% excise tax in Code Section 4960. Well, what do we see out there today? Doctors, MDs are getting involved in the administration of healthcare systems. And in certain roles, it's not just administrative, but they also have clinical duties. So they're a dual role employee. And that's when 4960 isn't so clear anymore. AST, administrative, supervisory, teaching services for our academic healthcare systems with physicians and, for example, the CMO spot, but also doing clinical services for either their medical group or one of the hospitals as well. And importantly, too, as you go through this analysis, what type of documentation is in the file for these dual role MDs for purposes of 4960? And that's real important for purposes of an IRS review in this area. Hayley already pointed out that this is a very big audit area issue coming forward from the IRS this year and the next few years. Rachel, next slide, please. And what they're also doing is they're reviewing hospital and healthcare system websites. So we're working for a client, we're looking at 4960 for the calendar year just closed. And we have an MD who received a couple $1 million of compensation on her W-2. So we went to the website, and you can read it here yourselves. The doctor, quote, wears 2 hats, primary care internal medicine specialist, but also, oh, by the way, in addition to providing direct patient care, he is the VP of the ACO at blank healthcare system. So the IRS will see this and they'll say, okay, where's the time study? Where's the documentation? How did you start with, for example, the $2 million of taxable compensation to get down to the exact dollar amount that could be subject to the 4960 excise tax for the administrative services duties that this physician is performing? Not so clear all the time. And this is right on the hospital's website. On the next slide, I'm going to walk everybody through an example or two. So year one, we've got 5 people over $1 million, pretty straightforward. You compute the excise tax calculation. It's only the excess over $1 million. And in this instance, you have 5 people that the organization pays the excise tax on. Employees 6 and 7, you can see I left them under $1 million just to make it clear. I'll also point out in year one, if number 6 and number 7 were over $1 million, the organization is still only paying excise tax on the top 5 who are deemed to be covered employees in year one. Now we roll into year 2, and it's not so clear because remember, once a covered employee, always a covered employee. So in year 2, all 7 are over $1 million. So the employer is going to pay excise tax on all 7. Why? Because the year 1 covered employees, 1 through 5, you could see that 2 people came into the top 5 in year 2, but a covered employee from the prior year, number 6 and 7, the CFO and the CLO, who were in the top 5 the year before, remained a covered employee, received over $1 million in year 2, and now the original 5 Now you're paying excise tax on a total of 7 people, because once a covered employee, always a covered employee, even if you're not in the top 5 in year 2. And this can grow and grow. And for example, too, deferred compensation and vestings can become an issue. The next slide, and this is where it gets crazy with multi-entity healthcare systems. What we're seeing is the parent entity is employing and issuing W-2s for not only corporate people, but also common law employer-employee relationships with hospitals in the healthcare system, but all the W-2s are coming out of the parent entity. So in my example here, I laid 1 through 10. They're all over $1 million. And you can see we have system people, 1, 3, 5, 6, 9, and 10. This is a real life example where a client actually said to me, well, we're just paying on the top 5. And I said, well, wait a minute, we have to peel back the onion here. Number 2 is a professor, academic medical center, who's the president of the system's medical group entity and also performs services. So what do we have here? We have a dual services MD, can likely exclude the clinical services piece from the $1 million, but her common law employer-employee relationship may likely be at the medical group entity, and the medical group entity would have to pay the excise tax on the $1 million, not system. So now we work our way down. Hospital CEO, Hospital 1 CEO. The CEO is really an employee of the hospital entity, not the system entity. That's an issue. The Hospital 1 likely has the excise tax liability. Number 7, you may have an umbrella foundation which raises funds for all entities in the system. It's a separate legal entity, a separate employer. That foundation, SVP of development, may likely be an employee under common law purposes with what the IRS deems to be, and the excise tax liability may be at that foundation entity for number 7. Number 8, again, Hospital 2 CEO, same with Hospital 1. So in my example here, you get system people who are 1, 3, 5, 6, and 9, and you actually have 4 others that you probably owe excise tax on in the system combined by other related entities. So you really need to peel back the onion and look at these things and really get very factual in terms of the employer-employee relationship, job duties and responsibilities. And on the next slide, we've just outlined some takeaways here. Really, when you're doing your 990s and working through them, you really need to pay a lot of attention to who are we listing on this specific entity 990? Who are my officers, key employees, and next 5 highest paids? What individuals are listed on the healthcare system's website? What are their titles? Who's senior leadership? Senior leadership of the parent entity, the university in the system, Hospital 1, 2, 3, 4, and also review direct reports in the employee organization chart to determine who's an officer, who's a key employee, and who should be shown on what 990. We talked about the employment agreements, and also another best practice here from a Withum perspective. Deferred compensation vestings can create covered employees who you didn't expect the previous year. So you need to also look at, and we recommend preparing a vesting schedule of deferred compensation by individual, by amount, by year, by their common law employer. And just a couple of things here to think about. We've seen transfers of employees from affiliates go to corporate positions. That creates something to look at as well. Who is the real relationship with? Who is the employment agreement with? What are the excise taxes and what entity? And lastly, we're going to talk about it a little bit later, but we're seeing a lot of municipalities for purposes of property tax exemption challenges also reviewing compensation on 990s. So I'll pause here and turn it back to Rachel. Thank you.
Thanks, Scott. So we're on to our first polling question. What is the federal tax rate for tax-exempt organizations with remuneration to employees in excess of $1 million? About 15 more seconds. All right, I'm going to close it out. And here are the results.
Okay, good job.
So it's like 21%. I'm sorry, 47% did 21%.
Great answer, everyone. Everyone got that right. The 47% got that 21% correctly. All right, good afternoon, everyone. So this next section, I'm going to cover IRS group exemption rulings. Just give a little brief background on them, and then also some new guidance that the IRS recently released with respect to that. They issued notice 2020-36 last year with some new guidance on the group ruling procedures. So if you just, next slide, Rachel, please. So just a little background on group rulings. Group rulings allow affiliated tax-exempt organizations the ability to file a consolidated Form 990. So basically, the parent organization, the central organization, would apply for a group exemption ruling with the IRS and include subordinates in that group ruling. So basically, there would still be two tax filings here. You'd have the central organization who files a separate 990 and then a consolidated Form 990 for the subordinates. There are some advantages and disadvantages with obtaining a group exemption ruling. One of the disadvantages here are each of your organizations have to give, each of the subordinates have to give up their separate tax exemption once they join that group ruling. So say down the year you have a group ruling, you have these organizations that join in as subordinates. Say 5 years down the road, one of those organizations for some reason wants to get out of the group ruling. They would then have to go reapply for tax exemption and refile the Form 1023 with the IRS and wait for that tax exemption approval. On the other hand, advantages, it's very easy to add new organizations to your group exemption ruling. On a yearly basis, the central organization is required to provide an annual update to the IRS. So in this annual update, you would just include any new organizations that want to be included in this group ruling. They don't have to file a separate 1023 in order to be included in the group exemption. For our hospital filers, if you have any tax-exempt hospitals that are included in your group exemption ruling, you would only be required to complete one Schedule H. So you might have some organizations, maybe a specialty hospital or a hospital that has a big Medicare population that they serve. So those, their Schedule H community benefit might be a little lower on the spectrum compared to other organizations. This, you just have one Schedule H completion, so you have, community benefit for the whole group as a whole there, and not any, outliers or, some that are a little bit below that stand out versus the other. Another advantage here is with reporting of the highest compensated employees. Normally, for 990 purposes, you have your officers, key employees, and then your next five highest compensated employees. So with the consolidated group ruling exemption, you're only required to list after those officers and key employees, the next five highest paid. So say for an example, you have 10 entities that are included in a group exemption. Separately, they would have your officers, key employees, and then the next five highest paid. So you could have a possibility of 50 highest compensated employees on those returns. This would cut that down to 5, so you would exclude 45 individuals from being reported on the 990. Next item, just Appendix E. Oh, sorry, go back. Just the last bullet point on here. Appendix E of the 990. This is specific instructions for group returns with regards to completing, the core form and any supplemental schedules. Kind of gives a guide there. So if you have a group exemption, we suggest looking at that and making sure you're in compliance with those. And then another item that was new for 2019 with regards to completing a group form 990, the organization is required to disclose a listing of subordinates included in the group return and also any subordinates which are not included in the group return, and that must be attached to the 990 filing. So make sure you're in compliance with that as well. On this next slide, I'm just going to talk about the new Notice 2020-36, which the IRS issued on May 1st, 2020. It provides new guidance on group ruling procedures in the form of proposed regulations procedures. Once finalized, this will supersede Revenue Procedure 80-27. As you can see here, the IRS oversees more than 4,000 group exemptions, which includes more than 440,000 subordinates. So main reason for this notice, just intended to reduce the administrative burden on the IRS and increase efficiency and transparency of the group exemption process. And then effective June 17, 2020, the IRS was not accepting any new group exemption request until the final revenue procedure is published. And then on this next slide, I just wanted to highlight some items, some tips that we noticed in Notice 2020-36, some new guidance here. So for essential organizations, in order to apply for a group exemption, they would need to have at least 5 subordinate organizations. And then once they're approved, they would need to maintain at least 1 subordinate thereafter. If essential organizations are only allowed to have 1 group exemption letter, so previously, essential organization could say have a group exemption letter that includes all their 501c3 organizations, and then have a separate letter that includes all their other, say, 501c4 organizations. So that's no longer allowed. Central organization must meet 2 tests with respect to subordinate organizations, either general supervision test or control test. General supervision test is that if the central organization on an annual basis reviews and retains information on the subordinate's finances, activities, and compliance with the Form 990, and they also educate the subordinates on what needs to be done in order to maintain their tax-exempt status. The control test is met if the central organization appoints a majority of the subordinate's board of trustees or officers, or a majority of the subordinate's board of trustees and officers are also trustees or officers of the central organization. One other item is the subordinate organizations must be described in the same paragraph of 501c3 as a central organization, except if you have government entities. For example, if the central organization is a 501c3 tax-exempt organization, then only subordinates, which are 501c3 orgs, can be included. Also, organizations classified under the same paragraph of 509A. So you're allowed to include in the group ruling any 509A1 or 509A2 entities, but you could not also include any 509A3 supporting organizations in that group ruling. Subordinates in the group exemption must adopt a uniform governing instrument. So say you have a group ruling that has different 501c3 orgs. So say you have ones that their purpose is related to school purposes and the others are hospitals. The schools must all adopt a uniform governing instrument describing their purposes, and then the hospitals must also adopt a separate uniform governing instrument. Lastly, as I mentioned a little bit earlier, the annual update letter. Currently, the central organization needs to file annually with the IRS 90 days prior to the close of the accounting period. This proposed regulation procedure extends that date to only needing to require it 30 days prior to the end of the central organization's accounting period. And I just wanted to point out as a last item here, old group exemption requirements remain in effect until this final guidance is published. And then I'm just going to turn it over to Scott right now, who's going to just give an employment tax update.
Yeah. Thanks, John, and definitely changes coming down the pike with respect to IRS group exemption rulings. Thanks. Okay, IRS employment taxes. On the next slide here, we thought it appropriate to point out some issues with respect to this area. And look at number 1, the IRS loves audit examinations in this area. With the additional people, and with audits coming down the pike, this is an area everybody should be looking at. Here are some of the issues that we see out there that you want to look at with your organizations, whether for-profit or not-for-profit in the healthcare system and your organizations. These all apply. Number 1, taxability of fringe benefits. For what we see in this area, for example, the IRS will come in and randomly select a number of months with expense reimbursements for some high-level people in the organization, let's say the CEO, CFO, and COO, and they will select 3 different months of expense reimbursements for those individuals to review all the documentation in detail. That's one area. Another area that we see quite frequently treated incorrectly, and the IRS loves it on audit examination, are S corporations. And if S corporations have shareholders that own 2% or more of the company, you can't generally deduct the health insurance premium attributable to that shareholder owner and his or her family. The correct reporting would be to report that value of the insurance premium on his or her W-2 annually, and then take a deduction for it on the S corporation return. We see that missed all the time with respect to S corporation treatment. Audits of the Form 1099 NEC are coming as well, and we'll chat about that. Form W-2 and a 1099 issued to the same individual. Worker reclassification from a 1099 to a W-2. Matching of employees' social security numbers to your 1099s. The IRS also does a complete audit via an Excel examination of the accounts payable paid file of each of your organizations. And number 8 has been a long time area for IRS review and scrutiny. Medical directorships, chairmanships, stipends, and on-call payments. And do they actually belong on a 1099 or do they belong on a W-2? And or if the physician employee is an employee and currently receiving a W-2 for other services, these types of things should be added to the W-2, and you don't issue a 1099 for these things to the same individual who's already be treated as a W-2 employee. So these are certain high-level profile areas that you want to be thinking about. On the next slide, we've enclosed a copy of the 2020 1099 MIS, which you've already filed. It was a revamped and revised form. And on the next slide, we have the 1099 NEC. And this was meant to reclassify the former Box 7 non-employee compensation on the 1099 MIS to the 1099 NEC. And these are where the audits are coming, because this is non-employee compensation. The IRS and the states are definitely going to be auditing the 1099 NECs that organizations, particularly in healthcare, filed for calendar year 2020. You're up, Rachel.
Great, thank you. So we're on to our second polling question. Has your organization applied for the ERTC with respect to the 2020 year? All right, 15 more seconds. All right, I'm going to go ahead and close it out. And here are the results.
13 yes, 19 in progress. Okay, not bad. So let's chat about ERTC, Employee Retention Tax Credit. It's been in the news and for about a year or so. And just a little background, the CARES Act last March created the Employee Retention Tax Credit. And to qualify, organizations needed either a fully or partial suspension due to orders from an appropriate governmental authority, or a significant decline in gross receipts. And for 2020, that was a 50% decline in gross receipts. It applies to qualified wages paid after March 12th, 2020, and through the end of the year. Your maximum ERTC is $5,000 per employee. It's a refundable payroll tax credit coming back to the employer. It's reported on an amended quarterly form 941, which is the 941X. And you can see here we've listed the link for the frequently asked questions on the IRS website. On the next slide, we outline the changes as a result of the Consolidated Appropriations Act signed into law December 27th last year and expanded the ERTC. Importantly, and we've doing a lot of this work for physician groups and smaller organizations in healthcare that actually received a PPP loan last year, you were ineligible to also apply for and receive the Employee Retention Tax Credit. Well, the CAA basically reinstated eligibility retroactively back to last year for smaller employees who received the PPP can now go back to 2020 and also apply for an ERTC refundable payroll tax credit. The CAA also expanded the ERTC for Q1 and Q2 of this year, and also increased that $5,000 credit to potentially $7,000 per employee per quarter. They also reduced the 50% decline in gross receipts test to 20% for Q1 and Q2 this year. And importantly, you want to take a look at Notice 2021-20. It replaced the FAQ guidance on the previous slide, and this is guidance with respect to the 2020 payroll tax credit refunds. On the next slide, we've outlined some areas you want to take a look at. Folks on the call, this is found money. We've gotten significant refunds of the ERTC for organizations in the healthcare space over the last year. Here's where it comes into play. Review on a state-by-state basis the government shutdown orders. We had very few clients satisfy the decline in gross receipts test, but most states shut down their state for commerce purposes, and particularly in healthcare, for a period of time last year. So we can apply for and examine that government shutdown period for purposes of the ERTC. You want to look at number of employees by employer. If you're a small employer under 100 employees and the affiliation rules don't bring in any of your other entities or any relationships, you automatically qualify for the ERTC as long as you paid employees. No brainer. Larger employers, there's a little more sophisticated analysis that you need to go through. But here are the areas where you can become eligible for the credit. Employee furloughs and did not use PTO. Employee furloughs, but you kept the individuals on your health care plan. You can also count for purposes of the credit for qualifying wages, health plan costs, employer costs of the health plan for the individual, as well as employee if it was on a pre-tax basis. We're also looking at COVID-19 pay code. People obtained or got COVID, had to self-quarantine, and you paid them. Or they had to self-quarantine because somebody in their household contracted COVID and you paid them. We can count those wages plus the allocable piece of the healthcare costs of the health insurance for purposes of the ERTC. We're also doing a lot of analysis with respect to looking at revenue producing clinical departments and picking up a percentage of the decrease, applying against qualifying wages, and picking that up for purposes of the ERTC. And clearly physician offices, ambulatory surgery centers, MRI facilities, they're all on the table for purposes of the credit. They were all affected by the government shutdown last year. Low-hanging fruit with respect to IRS payroll tax refunds. And then on the next slide, we'll also point out just two things. The tuition reimbursement and student loan forgiveness, you can amend your 127 plan now. That's your educational or tuition assistance program. And you can actually forgive up to $5,250 a year of an employee's student loan that they have with respect to going to college or graduate school, and you can that would be non-taxable for the employees. And there's also expanded benefits for your 125 plan, with basically people not being able to use medical care costs, co-pays, deductibles, et cetera, through a tax-free 125 plan, and also using the dependent care tax-free $125 for dependent care costs. They have now increased it. You can now have unlimited unused carryovers. You can access and use the amounts for the entire year rather than that 2.5-month carryover only. And they expanded changes to make two-year plan documents during the current year. And importantly too, if you have terminated employees, they can still seek reimbursement for any unused funds post-termination. And dependent care FSAs, they increase the child age to 14 from 13. You have to amend your employer plan documents, and they're optional, they're not mandatory to do. So just some other changes out there to make it more friendly for employees with respect to tax-free areas. And then on the next slide, just to wrap this up, beware, 1099 NEC audits are coming. We recommend, if it's a medical health care payment, put it in box 6 of the MIS, not in box 1 of the NEC. W-9 for all your AP payables, for all your vendors. There's an IRS TIN matching program. If you have incorrect TINs, you can go and check that out online to verify. You want to annually review all your non-1099 required vendors to determine whether or not they should be issuing a 1099 MIS or NEC. We recommend a review of both the payroll and accounts payable functions yearly to be sure that people are not receiving both a W-2 and a 1099. And the IRS always loves written policies, written documentation with respect to different areas of tax rules and regulations. And this is one where it's a no-brainer. You really need to and should have a written 1099 policy outlining the rules and regulations and how you annually do your reviews for compliance in this area. So those are just some payable, accounts payable best practices that we recommend. Thanks.
Okay, and so now our next section, I think we're going to chat a little bit about community benefit. This is something that, you know, our clients spend a lot of time on, and we know the IRS is deeply involved in as well. The first couple slides are just some quick snapshots of what's included in determining community benefit expense within Schedule H, Part 1, Line 7. And next slide. Then the slide 37 shows you Schedule H Part 3, which includes bad debt attributable to financial assistance or FAP eligible individuals, as well as your Medicare shortfall. These are two items that we know are not included in community benefit expense calculation, but it's often included when taking into account total benefits provided to the community. On the next slide, we just wanted to give you some benchmarking information, and that's where a lot of this section will lie. Annually, the IRS releases a report to Congress, of which the last was released about a year ago. And this includes community benefit information for the 2016 tax year. So obviously, there's a time lag on when the information is available for them and how long it takes to put it together. But as you can see, the total net community benefit provided was 9.42% of total expenses. 6.05% was attributable to charity care, Medicaid shortfall, and other means tested government programs. On the next slide, you'll see the American Hospital Association published information, and this is a report that they've been doing since 2012. They annually receive the information from the IRS and compile this. This information is for a year later, so it's based on the 2017 tax year, and the net community benefit expense for that year for all hospital organizations was 10.3% of total expenses, which was up from that 9.42% on the prior slide. And with that, I think we'll move to our next polling question.
We're on to our third polling question. What is your hospital's community benefit percentage for this most recent filed Schedule H of Form 990? All right, 15 more seconds. All right, I'm going to close it out. And here are the results. Like 37%.
Right. So for those of you that's applicable, you're between 8 and 12%, which is, you know, exactly where you want to be. We've always said you don't want to be the highest, you don't want to be the lowest. And, you know, based on the latest statistics, the organizations, you know, right around 10%, you're you know, in line with your peers, certainly. In addition to what AHA provides with respect to community benefit, they also provide information for total benefits to the community. And from what you can see here, that includes community building activities, Medicare shortfall, and bad debt expense attributable to financial assistance. And for 2017, the total benefits to the community was 13.8%. It also accounted for over $100 billion in benefits provided to the community. And just something to note, the AHA report is a really great tool. It further breaks down information by hospital size, also location, so suburban versus urban versus rural, as well as type. So you can compare yourself based on what type of hospital you are, critical access, teaching, and it allows you to better benchmark your hospital organization against your peers. And on the next slide, we've just got to mention some Schedule H planning ideas. And those include, certainly for this year, your upcoming 990s and the ones that are currently being done for fiscal 20. Take a look at your unreimbursed COVID-19 costs and see where there's opportunity for inclusion as community benefit. Unfortunately, there's not a lot of guidance in this area. The Catholic Health Association has put some information on their website, but nothing is definitive. And so what we're seeing is a lot of hospital organizations kind of leveraging each other to see where there's opportunities. In addition, as discussed in prior years, you want to take a look at your subsidized health services and the needs in your community, and take advantage of any health services to your related organizations. Take a look at physician recruitment, and also there's an opportunity to pull some of the information that's sitting in community building, which is included in part 2 of Schedule H. Take a look at it to bring it into community benefit. And we use the example that's listed on the slide, remediation of an apartment that contains asbestos to keep the community healthy rather than treat those individuals when they become ill. There's certainly some opportunity there, and the IRS is more generous in terms of figuring out if it's actually community benefit versus community building. And on the next slide, just some planning tools and tips. We like to recommend that folks put together a community benefit committee. This is super important because usually community benefit is gathered from finance professionals as well as your community benefit coordinators. If you have a community that all know to work together, can track the information, that usually yields better results when it's time to report it on the 990. You want to incorporate your community benefit statement into your 990 within Schedule O. Tell your organization's story and highlight the tax-exempt charitable purposes, programs, mission, and activities. Annually review and benchmark your community benefit information, both nationally and regionally. And lastly, educate your board and governance folks on community benefit so that everybody's informed on how important this story to tell is for your organization. And with that, I think we will pass it off to John for state and local.
Great, thanks, Hayley. As Hayley mentioned, Schedule H is an important reporting tool for tax-exempt organizations. It really tells a good story about, how they're helping the community they serve. As you can see here on these next couple of slides, states are really starting to look hard at organizations and the community benefit they provide. A flurry of bills have made their way through state houses in the recent years, including California, Oregon, and other states. As you can see here, Oregon, the governor signed a bill into law in June of 2020 that starting in 2021, state regulators will assign each hospital a mandatory community benefit spending floor every 2 years based on factors like the hospital's financial position, workforce, and community demographics. Colorado also passed a law in May of 2020. Tax-exempt hospitals are required to annually report their community benefits, costs, and shortfalls from the preceding year. Must also hold public meetings to gain some feedback on their community benefit activities and their implementation plan for the following year, and any feedback that they could get from the folks from the community that they're serving. Next, you have here Georgia, which has also, beginning October 1st, not-for-profit hospitals must post prominently on their websites their most recent community benefit spending reports, financial assistance policies, audit financial statements, and then as you see here earlier, Scott had mentioned something about reporting salaries. Now you have to report the 10 of the highest paid employees on your website for Georgia reporting purposes. And then California, this is still under consideration. This was approved by the California's House of Representatives, and it's making its way through the state Senate. It would require hospitals to submit annual reports to the state detailing out their community benefit spending amounts and activities. As you know, later on in the presentation, Scott's going to cover some federal level issues, but you could just see here that their states starting to really take a hard look at community benefit and make sure that their hospitals are really spending those funds to benefit their community and meet the needs of their community. On the next slide, for our New Jersey folks, I know this was a hot topic a couple years ago, and still we got some more guidance and some new legislation this year. But the big item that started this all in New Jersey was with the AHS Hospital Corp versus Town of Morristown. In this, the judge ruled against Morristown Medical Center that they were not entitled to a property tax exemption because of the for-profit activities which were being conducted on the hospital property. They seem to operate more similar to a for-profit business. The parties reached a settlement in November of 2015. As you can see here, they spaced least of physicians. See, these were some of the things that they noted in the, in the ruling. Gift shops, visitors garage, things of that nature, which kind of led to the ruling in this case. On this next slide, you can see that the settlement was approximately $25 million. And then here's some details on the settlement. Upfront payment of $10 million, total of $5.5 million over 10 years relating to penalties and interest, annual payments of $1.5 million, and then estimated potential liability is $2.5 to $3 million annually. So you can see quite a large settlement there. And then on the next slide, so with this court decision, it led to a flurry of lawsuits by municipalities against local hospitals in New Jersey, looking to revoke property tax exemptions. They try to assess real estate taxes based on the hospital's real estate value. In response to this lawsuit, in 2015, Trenton passed the annual service contribution fee, which was $2.50 per day for each licensed hospital bed and $750 per day for any facility that's providing satellite emergency care. This was pocket vetoed by Governor Christie, and then he put a 2-year freeze on property tax assessments. And then in May of 2017, they proposed new legislation that would have been effective 1/1/2018. The $2.50 per day bed tax remained in effect, and then they lowered that satellite fee down to $250 for the satellite ER. This bill never made it into law. And then if you see here where we're at today on this next slide, Governor Murphy signed into law on March 1st, 2021, community service contribution for 2021, which equaled $3 a day for each licensed bed that a not-for-profit hospital has effective 1/1/2020. Or if they had a pilot in place, it would be the greater of either the contribution, community service contribution, or the pilot. We've just put a brief example in here for you. If you have 500 licensed beds, the community service contribution would be $547,500 for 2021. It also provides for satellite emergency care facilities, which equals the $300 per day for satellite ER. This payment will be due quarterly, in equal quarterly installments, and then 5% of this will be shared with the county government to supplement like police services, municipality services, EMS, things of that nature. So if the installments are not paid when due, the unpaid amount constitutes a lien after 30 days and may be enforced in the same manner as unpaid real estate taxes. And then there is an exemption that exists. This is for if the owner certifies to the New Jersey Department of Health that in the prior year the hospital did not balance bill any patients, and that for Schedule H purposes they did report community benefit of an average of 12% over the past 3 years. And then lastly, a nonprofit hospital community service contribution study commission was created under this legislation and will report every 3 years to the governor and legislature on this community service contribution. Then we'll take a pause here for our fourth polling question.
Thank you, John. So our fourth polling question: has your organization been involved with a state or local tax examination recently? All right, 15 more seconds. All right, I'm going to close it out, and here are the results. Looks like 39% did no.
Yep, great. So you're lucky on that one. It seems like, as we've noticed, more and more states are looking at organizations and, looking to generate any funds they can, especially with COVID and budget deficits and things of that nature. So I'll just cover these next couple slides a little quickly in the essence of time. State and sales and use tax exemptions. So it exempts not-for-profit organizations for sales tax on for purchases. Each entity, so if you have an integrated healthcare delivery system with multiple tax-exempt organizations, they should each apply for their own exemption. So it's based on tax ID number. There's certain, state rules, state by state basis. There's very different. They have different rules with how they look at sales and use tax exemptions. New Jersey, for instance, you file for an ST5 application by filing an REG 1E. The certificate does not expire. You do not need to renew it. But on a Pennsylvania basis, you need to file an REV 72, and this needs to be renewed by your organization every 5 years. And then you also need to every 5 years, meet that purely public charity test. So once again, just a point of reference, review state by state rules. Each state has different rules and what they consider to be exempt from sales tax, and or if they even offer sales tax exemption to organizations. And then, if your organization, if you do have tax exempt organizations, check those state rules, determine if you are eligible. You can say this can be a savings opportunity for your organization in the future if you are able to apply for sales tax exemption in the state that you operate in. And then lastly, these next two slides, I'll just close this section out. Some state audits, some common audits that we see for healthcare organizations. Items purchased sales tax free for use by related for-profit entities. So we have tax exempt organizations that have a sales tax exemption, purchasing, not paying sales tax on equipment, and then the for-profit entities are using it. States are coming in, audit those, say you should have remitted sales tax because it's really for a for-profit entity. Other things, intercompany management fees. One big thing we always see is cafeterias in New Jersey, in a hospital. If it's only open to the employees, there's no sales tax required to be remitted. But once you open it up to the public, all sales in that cafeteria require to, remit sales tax on all sales. So that's something that, you want to look closely at and don't want to fall victim to a sales tax audit here. And also technology. This is kind of a gray area. You see a lot of states with differing thoughts on this. Some of them, if it's just software is as a service, they're not charging sales taxes because it's not considered tangible personal property. But any type of other installation, maintenance, service, repairs, things of that nature might be subject to sales tax. So just wanted to drive home, check with your state regulations, make sure you're in compliance there. You just don't want to fall victim to one of these state audits and, have unexpected fees that your organization has to pay here. And I'll pass it over to Hayley for a UBI update.
Yeah, a UBI update, guys. Honestly, not much going on here since, I'm sure you've been hearing about, the final regulations were published November 30th, 2020. Two biggest changes were the implementation of siloing UBI activities and also the QPI, the generally treating qualified partnership interest. If your capital or profits interest is less than 2%, then it could be treated as one trade or business, which was really great for organizations involved in alternative investments. Where I really want to point your attention is to slide 62, just for some of our quick best practices. If a reasonable basis exists, we recommend treating income as related rather than unrelated business income. Therefore, not giving the IRS an annuity and looking for it annually. If UBI exists within your organization, do not incur large net operating losses year over year. Additionally, identify any directly connected expenses, allocate indirect expenses using a reasonable method, and make sure that you maintain really good UBI work papers. We've been involved in several unrelated business income audits over the last, I'd say, 2 years, and they really want to see those work papers that back up the numbers that are being reported on your 990T. And lastly, all new activities, programs, investments, especially with respect to joint ventures, really should be reviewed for tax purposes prior to getting involved, because there's a lot of things that can be done to make sure that those are potentially not subject to unrelated business income. And with that, I'll pass it back to Scott to quickly take us home.
Thanks, Hayley. The last section of the day is 501R, and consistent with the theme today, IRS compliance checks and 501R continue, similar like tax audits. On the next slide, we outline briefly 501R, and I think most of us know it already. You need to conduct a community health needs assessment once every 3 years and adopt a written implementation strategy and make that widely available. And then Code Section 501R 4, 5, and 6 has to do with a written financial assistance policy, a plain language summary of the policy, and also your billing and collection efforts in a written policy, and also calculate an amounts generally billed calculation. Most importantly in this section, and we've included a lot of newspaper articles, this issue is not going away. It continues to be at the forefront of the IRS, as well as the Senate Finance Committee being involved. There are 3 very large, high-profile cases in the news. One is Mosaic Healthcare from the state of Missouri. The other is Methodist, which is the largest healthcare system in Memphis, Tennessee. And the third is University of Virginia Health System. And Senator Chuck Grassley, Republican of Iowa, has led the Senate Finance Committee when the new 990 came out. He rotated back on in January of 2019, and immediately he sent a letter to the IRS in February of 2019 asking about 501R compliance efforts. So we're going to slowly, well, somewhat quickly, in the interest of time, Rachel is going to just page through these newspaper articles. They all have hot links to it. And you can see, importantly, the next few roll right through COVID. So for example, UVA Health kicked off in September of 2019, and that has been ongoing during the COVID pandemic. There was an article for University of Wisconsin Health that we included in here from April of 2020 last year with respect to egregious billing and collection efforts and lawsuits of tax-exempt healthcare systems. That continues. Kaiser Health News publishes a Bill of the Month club with respect to an unsatisfied consumer and egregious billing and collection efforts. Would encourage you to go through these, page through these on your behalf when you have some more time, and just see what's out there and talk about it in your organization so you can really see what's going on out there, because this issue is not going to go away. So on the next couple slides here, Rachel, if you may, keep going and stop right there. The next 4 slides, the first 2 are Code Section 501R3 IRS information document requests when it performs an actual 501R compliance check. They want written documentation. They want to know about posting your community health needs assessment, your implementation strategy on your website. They want to know who is involved with the process. And this is an actual IRS IDR. Rachel, go forward 2 more, please. And this is an actual IRS IDR for 501R4. Tell us about your financial assistance policy. How did you set and establish rates for financial assistance for patients? Did you translate the policy? Do you make signs available for financial assistance conspicuously on your website and on your bills? Who was involved with all of this process? Was a board involved? Was a committee involved? And importantly too, the IRS actually conducts a tour of the hospital premises looking for things like signs for availability of financial assistance. So take a look at these, do a dry run, do a mock audit, and compare yourself to these IRS IDRs, read the debt collection newspaper articles, and compare it to what you're doing right now with your organization, so you're not the next healthcare system presumably in the news. Rachel, the next slide. And one more. And here are just some best practices. Take a tour of your hospital facilities. Be sure those signs are up. Check your website links for your FAP, your PLS, your billing and collection policy, your community health needs assessment. Do you need to translate any of these documents into any other languages other than English? You have to update your amounts generally billed calculation on an annual basis. You have to update your provider listing. We recommend updating it at least twice a year. There's an IRS safe harbor that says you should do it quarterly. We think it's a bit much, but twice a year at a minimum. Review your collection agreements. Those vendors that you use for billing and collections should be bound by Code Section 501R. And 7 is real important here. What's your current information with respect to collections, lawsuits, garnishments, liens, debts reduced, debts forgiven? These are things that, we are starting to talk with our healthcare system clients about getting this documentation together. Should we just unilaterally forgive a bunch of outstanding patient debt because you're not going to collect it anyway? Let's put it in a document. Let's memorialize it. Let's put it in a file. So if the IRS does come and perform a 501R check, or you're in the newspaper for executive compensation and community benefit that John and Hayley were speaking about later, we have a nice response, presumably, to put together. It was put together contemporaneously in the file for these sorts of things to rebut or respond to either the IRS or certainly the newspaper. Again, perform an annual internal review and assessment of your financial assistance policy. Test 25 to 50 patient claims, medical records from start to finish who are eligible under your FAP. What did you do? How did you notify them of financial assistance? How did you calculate AGB versus what they owed? Was it written down properly? And did your systems actually capture the numerical information the correct way? And importantly, too, we talked about it earlier, in the result of, an acquisition, a merger, affiliation, you need to be doing some due diligence with respect to the acquiree of the other hospital. So just some best practices you want to be thinking about. And then lastly here, I'm just going to conclude everything, again, three big themed takeaways here. Number one, federal, state, and local tax audit examinations are on the rise. More agents, more audits, they're focused on the healthcare industry. Number two, a lot of the things we spoke about here today are applied to for-profits and not-for-profit organizations. The not-for-profits also have community benefit, 501R, and Code Section 4960, excess remuneration excise tax, that the for-profits on a call don't have, but those other areas that we spoke about apply to both for-profits and not-for-profits. Employment tax audits, state and local initiatives, et cetera, et cetera. And importantly, in all these things we've talked about today, we can't stress it enough, when you're doing an acquisition, a merger, an affiliation, you want to do tax due diligence in these areas so you don't get burned down the line following the closure in an M&A deal. And there's lots of M&A, as we all know, going on in the healthcare industry today. I'm going to conclude here. I want to thank everybody. We went a couple minutes over. Nobody really dropped off. We've got a ton of questions. We're going to follow up with them directly via email. We'll remind everybody as well, we have upcoming Withum Healthcare webinars, April, May, and June. And I'm just going to turn it over to Rachel now for final word. I want to thank everybody for joining us today. Thank you very much.
Thank you, Scott. And as Scott mentioned in your handout, you can access the links to register for our upcoming webinars. And we also will be sending out a recording and the PDF of the presentation as well. Scott, Hayley, and John's contact information is in here as well. And again, we want to thank you all for joining and thank our collaborators for helping us with this event. And please register for upcoming webinars. Thank you and have a great day.